Okay, so we've looked at prepaid expenses. Now we'll look at unearned revenues, which also fall under the prepayments category. Unearned revenue is defined as cash received from customers before the revenue is earned. So before goods are delivered, services are completed, or those contractual obligations are met. So I said cash is received from customers before revenue is earned. And we discussed at the start of the chapter, revenue is earned when goods are delivered, services completed, or contractual agreements are met. So this is cash being received before that happens. Unearned revenue is what type of account? Right, it is a liability because it represents the entity's obligation to deliver goods or services. So the company owes these products or services or the contractual obligation. And we know a liability is when something is owed to an outsider. So we only can recognize this revenue once the service is provided, product delivered, and that revenue is earned. And once this is earned, we then do an adjusting entry to record that. So I want to note here too that unearned revenue and prepaid expenses are kind of opposites, or they're two sides to something. So one company would have prepaid expenses. So that company paid something in advance to another company. And the second company that received that money in advance, they had this unearned revenue. So it's showing two sides when that happens. Whoever pays early has the prepaid. Whoever receives the money early has this unearned revenue. And unearned revenue makes sense. It is not earned yet. And deferred revenue is another term for this. And it's saying we're deferring recognizing our revenue until the future when it's earned. So that is where that name comes from. Okay, let's look at an example. HEC receives a cash advance of $3,000 on May 21st, 2019 from a customer for a 30-day service project, which begins tomorrow, so on May 22nd. First, we would record the entry on May 21st when that cash is received. So this is a journal entry, not new. This is what we learned earlier. So we are receiving cash, so we are going to debit that, which is how we increase it for $3,000. And since we haven't done anything yet, they're paying us in advance, we are going to credit unearned revenue. We received revenue in advance. And I just want to point out here as well, you can see how important debits and credits are. So we learned them in the previous chapter, but we are going to use them every day, as I said. So you need to know what type of counts these are. Cash is an asset. We're increasing it, so we're debiting it. So I'm not going to be walking through that anymore. That's something I expect you guys to know to be able to complete these adjusting entries. Okay, so that was the 21st. Now we get to the end of the month, May 31st. We need to record an adjusting entry if needed. So if the project, it said, started tomorrow, it started on May 21st. It's a 30-day project. Do we need to recognize any revenue for this end of May? Yeah, of course we do. We would have done some work in this period of time, so we need to recognize enough for that period. So first, we've got to figure out how many days. So don't be afraid on an exam or something like this to count on your hands. Make sure you're calculating this properly because you need to get this information right to know the dollar value. So you can't see me counting on my hands, but I am. So we've got the 22nd, 23rd, 24th, 25th, 6th, 7th, 8th, 9th, 30th, and 31st of May. So we have 10 days. And we need to recognize revenue for those 10 days. So to figure out the amount, we know it was $3,000 for a 30-day period. So we can divide by 30 days, which gets us to $100 per day. And we just said we have 10 days in May that we've done the work, so we can multiply by 10 days, which gets us $1,000. So that's the amount that we've earned out of this project. Or another way you could calculate that, $3,000, just go times 10 over 30, because we've earned 10 out of the 30 days, and that gets us to $1,000. So either way, whichever of these calculations makes more sense with you is fine. Okay, so we know our amount. We're going to debit $1,000. What accounts are we going to adjust? So we know we've earned this revenue. That means we're going to record that much revenue. To increase our revenue, we credit it. So our credit here is to service revenue. But we need to decrease our unearned revenue that we set up above. So that will be our debit. We are decreasing unearned revenue, which is that liability account, because we owe less. We've already done work for these 10 days, so we can decrease by that amount. Okay, we look at the T accounts for this example. Here's what we'll see. Our unearned revenue, the liability, we recorded the amount when we received the cash. Now we're recognizing $1,000 of the revenue. So this $2,000 is what we still owe. So we still owe 20 days in the contract at $100 a day, which gets us to $2,000. And we've recognized, oops, that should just be 1,000. We've recognized $1,000 of revenue, so that is the balance that we have. Now again, when we do these adjusting entries, we're always hitting two things. There's always two sides. So here we are updating the liability as well as the revenue. So take a second and think about this. How would the financial statements be impacted if this adjusting entry on May 31st was missed? Well, our liability, again, if we didn't have this May entry, our balance would still be at the $3,000, which we know is too high. So this would be overstated. And if we didn't have the revenue amount, we would be at $0 in revenue. So this would be understated. Revenues are understated. What is the impact on net income? Right, well, revenues minus expenses. So if our revenues are too low, they're understated. Our net income would also be understated. And we know we add net income in when we're calculating capital or that equity on the statement of equity. So if net income's understated, when we add that, we're adding too little, so our capital would also be understated. Lots of impacts that we can see here. Okay, so that is unearned revenue. Again, I have posted another example of these under the practice area right below all the videos. You can go take a shot at that.